On January 14, 2025, the National Pension Service (NPS) of South Korea took significant action in the foreign exchange market in response to the depreciation of the Korean won and the strengthening of the US dollar. This intervention followed a series of internal guidelines set by the NPS triggered by a weakening won that had crossed a critical threshold. Background and trigger. In December 2024, the NPS established an internal guideline that came into effect when the average closing exchange rate of the Korean won against the dollar exceeded 14.51 for 5 consecutive trading days. By January 2025, this threshold was breached, prompting the NPS to intervene in the foreign exchange market to stabilize the currency. Measures implemented by NPS. 1. Dollar sales. On January 13, 2025, the NPS began selling dollars in the market. Initial sales involved hundreds of millions of dollars, which were reportedly executed in the forward market. The NPS aimed to counter the effects of the dollar's strength and the won's depreciation through strategic currency hedging. 2. Strategic currency hedging. The NPS employed a mixed strategy for dollar sales. This included utilizing currency swaps with the Bank of Korea for new overseas investments while simultaneously selling existing investments through forward contracts. These combined measures aimed to reinforce the NPS position in the market. 3. Market response. Following the NPS intervention, there was a slight recovery in the Korean won. On January 14, 2025, the exchange rate improved to 1,463.851 per dollar. This change in the exchange rate reflected a shift in market sentiment partly influenced by broader economic expectations, such as potential adjustments in U.S. tariff policies under the incoming administration of President-elect Donald Trump. Analysis of the situation. The NPS intervention highlights a proactive approach to managing currency volatility amid external economic pressures. The decision to implement these measures was influenced by a combination of factors including global economic conditions. The strengthening US dollar was driven by various global factors including interest rate differentials and economic growth prospects, which put pressure on the won. Domestic political uncertainty. Political dynamics within South Korea also contributed to market volatility, prompting the NPS to act decisively to instill confidence in the currency. Media coverage and perspectives. Coverage of the NPS actions varied across different media outlets, but several common themes emerged. Urgency of measures. Most reports emphasized the necessity of the NPS intervention in light of the rapidly depreciating won. Internal guidelines. Articles consistently mentioned the internal guidelines that triggered the dollar sales, underscoring the structured approach taken by the NPS. Market sentiment. Some outlets focused on the correlation between the NPS intervention and the subsequent improvement in market sentiment, indicating that the measures helped stabilize investor confidence. Conclusion. The National Pension Service's measures to sell dollars and hedge against currency fluctuations represent a strategic response to the challenges posed by a depreciating won. By implementing these actions, the NPS aims not only to stabilize the currency but also to enhance market confidence amid external economic pressures. The effectiveness of these interventions will become clearer as the market continues to react to both domestic and international economic developments in the months to come. The measures taken by the National Pension Service (NPS) of South Korea in response to the depreciation of the Korean won and the strengthening of the US dollar reveal several counterintuitive aspects. 1. Market intervention versus market dynamics. Typically, market forces such as supply and demand dictate currency values. However, the NPS intervention by selling dollars to stabilize the won suggests that sometimes governmental or institutional interventions can play a significant role in countering market dynamics. This challenges the conventional wisdom that markets are self-correcting. 2. Currency hedging as a response to weakness. Currency hedging is often seen as a defensive strategy employed to mitigate risks associated with adverse currency movements. The NPS choice to enhance its currency hedging strategy when the won was already weakening might seem paradoxical. Instead of waiting for a recovery or stabilization, the proactive approach of hedging during a downturn indicates an unexpected level of confidence in the potential recovery of the won. 3. Impact of political events on economic decisions. The NPS actions were linked to external political factors. Specifically, the economic team of the new U.S. president considering adjustments in tariff policies. This suggests that international political events can have immediate and significant impacts on domestic economic strategies, which might be unexpected for investors who traditionally consider economic indicators as the primary drivers of currency values. For selling assets during a downtrend, the NPS decision to sell dollars, which typically would be viewed as a negative indicator suggesting further depreciation of the won, resulted in a slight strengthening of the won. This counterintuitive outcome illustrates that selling can sometimes lead to increased demand or improved sentiment in the market, challenging the expectation that selling pressure always leads to price declines. 5. Internal guidelines triggering intervention. The NPS had set specific internal guidelines that dictated when to intervene in the currency market. The predetermined nature of these guidelines might appear rigid, but they ensured that the NPS acted decisively rather than reactively. This structured approach can be seen as counterintuitive in financial markets where flexibility and adaptability are often emphasized. 6. Quantitative measures of intervention. The potential for the NPS actions to result in up to $50 billion in local currency purchases indicates a magnitude of intervention that can significantly alter market dynamics. This raises questions about how large institutional actions can lead to substantial shifts in market sentiment and currency values, which may not align with smaller-scale market fluctuations typically seen. 7. Market sentiment and currency strength. The slight recovery of the won after the NPS dollar sales indicates that market sentiment can be more influential than the underlying economic fundamentals at times. The expectation of future policy changes and the resultant market sentiment played a larger role in the currency's immediate recovery than the actual mechanics of supply and demand might suggest. These counterintuitive elements highlight the complexities of currency markets and the sometimes unpredictable impact of institutional actions and external political events on currency values. The recent measures taken by South Korea's National Pension Service (NPS) in the foreign exchange market are significant for several reasons. And there are important details within the reports that many readers may overlook. Here's an exploration of those overlooked aspects and their significance. 1. Internal guidelines and triggers for intervention. The establishment of internal guidelines by the NPS which trigger intervention when the Korean won's exchange rate exceeds 1450 KRW per USD for 5 consecutive trading days is a critical detail. This systematic approach to intervention underscores the strategic financial planning involved. The significance lies in the fact that it is not merely an impulsive reaction to market fluctuations, instead it reflects a calculated strategy to maintain currency stability. These guidelines indicate a proactive stance, allowing the NPS to act when certain thresholds are met, which can help prevent panic in the markets and instill confidence among investors. By having a clear framework, the NPS aims to mitigate the risk of hasty decisions that could exacerbate volatility. 2. Mixed methods of dollar sales. The NPS implementation of a mixed approach to dollar sales involving both new overseas investments through currency swaps and selling existing investments via forward contracts is another aspect that warrants attention. This dual strategy illustrates the NPS efforts to balance immediate market needs with long-term investment goals. This nuanced approach is significant because it showcases the NPS flexibility in managing its foreign reserves while still aiming for currency stabilization. By leveraging both new investments and existing assets, the NPS can better navigate the complexities of the foreign exchange market without compromising its overall investment strategy. 3. Market sentiment and external influences. The reports highlight that after the NPS began its dollar sales, the won showed slight strengthening. which reflects a shift in market sentiment. This connection between the NPS actions and market reactions is significant as it demonstrates the impact that institutional interventions can have on currency valuation. What may be overlooked is the role of external factors such as the incoming U.S. administration's economic policies, particularly regarding tariffs, in influencing market sentiment. This underlines the interconnectedness of global financial markets, where domestic currency values can be swayed not only by local actions but also by international political and economic developments. 4. Potential scale of intervention. The possibility of NPS interventions amounting to up to $50 billion in local currency purchases is a staggering figure that may not receive the scrutiny it deserves. The scale of this intervention signals the NPS commitment to supporting the won and reflects the severity of their concerns regarding currency depreciation. This level of intervention could have significant implications for both the Korean economy and global financial markets. A substantial influx of capital into the market can lead to changes in liquidity and influence investment strategies among other institutional investors. Therefore, understanding the potential scale of the NPS actions is critical for predicting market trends. 5. Long-term implications for the pension fund. Another important but often overlooked element is the long-term implications of these interventions for the NPS itself. While the immediate goal is to stabilize the won, the methods employed, such as selling off investments, could affect the fund's overall performance and asset allocation strategies. The NPS must balance the need for currency stabilization with its obligations to pensioners and beneficiaries. This delicate balance is significant because it raises questions about the sustainability of such interventions and the potential risks involved in depleting assets for short-term objectives. 6. Institutional confidence and policy framework. The reports imply a broader context of institutional confidence that these measures aim to bolster. The proactive stance of the NPS can be seen as a signal to both domestic and international investors that South Korea is committed to maintaining economic stability. This is significant because it can influence investor behavior, potentially leading to increased investment inflows, as stakeholders may perceive South Korea as a more stable and reliable market. The implications of building confidence among investors can be profound in terms of economic growth and stability. 7. Regulatory and market implications. Lastly, the regulatory environment surrounding foreign exchange interventions in South Korea is worth noting. The NPS actions may prompt discussions around the regulatory framework governing currency interventions and market operations. This aspect is significant because changes in regulatory policies could lead to new frameworks for how such interventions are conducted in the future, impacting not only the NPS but all market participants. Understanding these regulatory dynamics is essential for anticipating future market behavior and interventions. Conclusion. In summary, while the primary focus of the reports on the NPS foreign exchange measures may center on the actions taken to counter the depreciation of the Korean won, several critical underlying details deserve closer examination. The establishment of clear internal guidelines, the mixed methods for dollar sales, and the implications for market sentiment, the scale of intervention, and long-term impacts on the pension fund are all significant aspects. These details not only provide a deeper understanding of the NPS strategies but also highlight the complexities and interconnectedness of global financial markets in which these actions are taking place. Understanding these nuances is crucial for comprehending the broader implications for South Korea's economy and the global financial landscape. 1. Strategic currency hedging implementation. The National Pension Service (NPS) of South Korea has initiated strategic currency hedging to mitigate the impacts of the depreciating Korean won and the strengthening US dollar. This involves setting internal guidelines that trigger market interventions when the exchange rate exceeds a specific threshold, thus ensuring a systematic approach to currency management. The decision to begin selling dollars was activated when the won surpassed 14.50 to $1 for 5 consecutive trading days, highlighting the NPS focus on maintaining market stability. 2. Market intervention effects. The immediate effect of the NPS dollar sales was a slight recovery in the value of the won, moving to 1,463.85 per dollar shortly after the intervention. This suggests that the market responded positively to the NPS actions, reflecting improved risk sentiment. The correlation between the NPS measures and market reactions indicates the potential effectiveness of such interventions in influencing investor confidence and stabilizing currency fluctuations. 3. Mixed methods of dollar sales. The NPS employed a mixed strategy for its dollar sales, utilizing both new overseas investments through currency swaps with the central bank and selling off existing investments via forward contracts. This dual approach not only facilitates immediate liquidity but also diversifies the NPS financial strategies in dealing with foreign exchange risks. By engaging in both new investments and liquidation of existing ones, the NPS aims to optimize its currency management while addressing the overarching issue of currency depreciation. For long-term implications on market confidence, the interventions by the NPS are not just a reactionary measure but also a strategic attempt to bolster investor confidence in the South Korean economy amidst external pressures. As market responses indicated a shift in sentiment following the NPS actions, this suggests that effective currency management could play a critical role in maintaining economic stability. The success of these measures will likely influence future policy decisions and foreign investment in South Korea, making it a crucial area for ongoing analysis and discussion. 1. The 1992 Black Wednesday crisis. In September 1992, the British pound faced severe pressure as speculators led by George Soros bet against it. Soros's quantum fund sold billions of pounds, forcing the UK government to withdraw the currency from the European Exchange Rate Mechanism (ERM). The pound depreciated significantly, leading to substantial losses for the Bank of England and highlighting the vulnerabilities in currency pegs and the challenges of maintaining fixed exchange rates amidst speculative attacks. 2. The Asian financial crisis 1997 to 1998. This crisis began in Thailand with the collapse of the Thai baht, which was pegged to the US dollar. Speculators attacked the baht, leading to its devaluation and triggering a regional financial crisis that affected several Southeast Asian economies. Countries such as Indonesia, South Korea, and Malaysia faced severe currency depreciations and economic turmoil. Various governments, similar to the NPS measures, implemented interventions in foreign exchange markets, including interest rate hikes and selling foreign reserves to stabilize their currencies. 3. The 2008 global financial crisis and currency interventions. During the 2008 financial crisis, many countries faced significant currency fluctuations as investors sought safety in the US dollar. Central banks, including the Bank of Japan and the European Central Bank, intervened in the foreign exchange markets to stabilize their currencies against the dollar. These interventions included direct sales and purchases of currencies in coordination with other central banks to enhance liquidity and restore confidence in their financial systems, mirroring the proactive steps taken by the NPS in response to the won's depreciation. The future outlook for the National Pension Service (NPS) of South Korea and its foreign exchange market interventions indicates a complex interplay of global economic factors, domestic policy adjustments, and market sentiment. Here are some predictions and considerations for the coming years. 1. Continued market interventions. The NPS is likely to maintain its active role in the foreign exchange market as long as the won remains under pressure from external forces, particularly the strength of the US dollar. As global economic conditions evolve, the NPS may need to refine its triggers for intervention to prevent excessive volatility in the won. This could lead to more sophisticated and proactive measures, including enhanced currency hedging strategies and partnerships with other financial institutions. 2. Long-term currency stabilization. If the NPS interventions prove effective in stabilizing the won, it may lead to a more favorable environment for foreign investments in South Korea. A stable currency can enhance investor confidence, potentially attracting foreign direct investment (FDI) and supporting the broader economy. However, if the interventions are perceived as insufficient, it could trigger further volatility and skepticism regarding the NPS effectiveness. 3. Impact of global economic conditions. The NPS actions will be heavily influenced by global economic trends. Factors such as U.S. monetary policy, geopolitical tensions, and commodity price fluctuations will play significant roles. For instance, if the U.S. Federal Reserve continues to tighten monetary policy, it may lead to a stronger dollar, prompting further interventions by the NPS. Conversely, a more dovish stance from the Fed could alleviate some pressure on the won. 4. Domestic economic policies. The South Korean government may also implement complementary economic policies to address the root causes of currency depreciation. This could include measures to boost exports, enhance productivity, and stimulate domestic consumption. A coordinated approach between the NPS and government policies could amplify the effectiveness of currency stabilization efforts. 5. Increased focus on diversification. In light of the ongoing challenges in the foreign exchange market, the NPS may prioritize diversification in its investment strategies. This could involve reallocating assets to different currencies or investment vehicles that are less susceptible to dollar fluctuations. A diversified portfolio can help mitigate risks associated with currency volatility and enhance overall returns. 6. Technological innovations in currency management. The NPS may increasingly leverage technology and data analytics to enhance its currency management strategies. Advanced algorithms and predictive analytics could provide insights into market trends, allowing for more timely and informed decisions regarding currency interventions. The adoption of such technologies can lead to improved efficiency and effectiveness in managing foreign exchange exposures. 7. Market sentiment and investor behavior. The NPS interventions will also depend on market sentiment. If investors perceive that the NPS actions are stabilizing the won, it may foster a positive feedback loop, encouraging further investment in South Korean assets. Conversely, if market participants view the interventions as reactive rather than proactive, it could lead to increased volatility and risk aversion among investors. 8. Regulatory and policy changes. Future regulatory changes in both South Korea and globally could impact the NPS's ability to intervene in currency markets. Increased scrutiny of pension fund activities and foreign exchange transactions may lead to more stringent regulations, affecting how the NPS conducts its operations. Staying ahead of regulatory developments will be crucial for the NPS to navigate these changes effectively. Conclusion. In summary, the NPS interventions in the foreign exchange market are expected to continue as it seeks to stabilize the won amidst global economic fluctuations. The effectiveness of these measures will depend on a combination of domestic policies, global economic conditions, and market sentiment. As the NPS adapts to these challenges, it may explore innovative strategies and partnerships to enhance its currency management capabilities. The overall outlook remains contingent on the interplay of these factors, with potential for both challenges and opportunities in the evolving financial landscape.